Why don't you give us the 30,000 foot view, if you like? What are you looking for when you search out these long-term opportunities, these macro, these thematics, these opportunities that you're seeking for the fund? What is it primarily that you're looking for? And then maybe you can distill the universe down into more manageable process and list that you work from.
Well, you've asked to start at a high level, so let's start at a very
Okay.
high level. Before we get in the macro and why the macro comes into the process, the very first thing we're wanting to do is to invest in a concentrated portfolio. Let's call it 25 names. Mm-hmm. I call it a football team of the world's best businesses. So we want to invest in businesses that earn high returns on capital, high returns on incremental capital, and have very durable and long-term sustainable competitive advantages, or what Buffett would refer to as an economic moat to them. So we have a number of different sector teams, how we organise our research. We've got a global franchises team. You could think of a Nestle or a Coca-Cola or a Yum Brands or a Starbucks fitting into that world. We have a global financial services team. You could think of the big banks of the world fitting in that. You could think of the card payment networks fitting into that. You could think of stock exchanges and rating agencies and like businesses fitting into that world. We've of course got a technology, media and communications team. People may have noticed we've made some technology investments over the last 5 years. We've got a very, very specialist team, but it goes across a whole series of things from semiconductors to enterprise software, some hardware, some advertising platforms would sit under that space. Communications infrastructure would sit after that. Some media, very selective media sort of organisations, most of that's unattractive to us, would fit. And of course we've got our large infrastructure capability and business that Gerald Stack has done a terrific job in that. And really what we do is we identify from that universe is really what are the best businesses. And then our job is to have our analysts value those businesses. And out of that, we will select a concentrated portfolio at the best prices we can. So the core is a concentrated portfolio of just truly outstanding businesses in the world with high returns on capital. And it's very important why we're there, because if you believe in the magic of compound interest, you want to compound with two things. One, you want to have some growth behind you, and we'll come on to macro. And the second thing is you want to have high returns on capital. And they only really exist in these really outstanding companies. And you want that to endure for long periods of time. If you think of how the magic of compound interest works, and we're in a very unique, a truly unique universe where we're shopping in. And you can only get excess returns in that because most of the world knows these companies are good businesses. The only way you can get excess returns in that space is in by concentration of having a very focused portfolio. You asked a question on macro. There's two elements on macro that then get fed into our process. One is something I call macro event risk management. So are there some very profound things going on in the world that could cause a major market correction or something to happen? And we've done a number of things over the years. Before the financial crisis, we were warning people there was a very material risk that a major hedge fund or investment bank would go down with a prime brokerage run, and that's what happened with Bear Stearns. We were very early out of the gates what was going on in the European sovereign debt crisis. We've been navigating around the tightening of monetary policy in the world, sometimes very successfully and sometimes too early on that topic. So that's really sort of risk management, and then we use our sort of cash to move around some of those events to change the risk ratios we use in the portfolio. And the second part of which you're kind of almost asking a thematic question is that is growth at the end of the day. And you really want to be investing where the winds are blowing. If you can find businesses, particularly in the world we're in, and we could talk about interest rates, it's a very interesting question, but if you can find businesses that have high returns on capital and could grow at least 4% a year for the next 20 years, they are incredibly valuable compounding machines. If you could find them growing at 6% a year, hold on to your chairs if it lasted for 20 years. We've owned Yum Brands that it's been growing at sort of 10% per annum, and we've owned it for 12 years now, and we've made over 7 times our money in Yum Brands. It's slightly more than that if you take the spin out of Yum China. Visa and MasterCard, we haven't been in quite as long. Again, we're up at around 7 times our money on Visa, and they've been growing at sort of 12% a year. So we're really trying to find the sort of the long-term structural growth stories. We've been very big on payments, as you know, in the world. So we spend a lot of time thinking about really where are those next areas of structural growth in the world, and where are the businesses that have deep competitive advantages in that space. And the game's got even more interesting with what's happening in interest rates.